Hello and welcome. I'm Christine Zhou reporting for ATF TV from London. Today we are pleased to have Varut Prambun joining us. Varut leads Bond Critics Credit Research and Consulting Practice, and with a credit research career spanning 26 years. He is adept with structured finance, leverage finance, credit risk management, sell-side credit research, treasury, and rating advisory. Today, Varut joins ATF TV to talk about China's debt problems, a subject he also looked at in a recent ATF article. Varut, a very warm welcome to ATF TV.
Thanks, Christine. Great to be here.
Varut, the Chinese debt bubble is back in the spotlight. Why is that? And perhaps it would be useful to sum up the issue, as in exactly what is the Chinese debt problem?
Chinese economy is more of a, what we call a bicycle economy, where, if it doesn't grow above a certain rate, it will fall apart, either left side or right side. And a lot of economists were saying that, the economy has to grow above 5% for the bicycle to keep going. Last year, we have 2.3%. So now everyone is feeling the heat now because the bicycle is falling, and the government is aware of that. So it's coming down to tell, the worst borrower, if you will, to behave, basically.
Varut, in your recent Asia Times financial article, you mentioned the lack of good quality credit research and credit ratings in China. How so?
Right.
And can you please elaborate?
Well, here's the thing. China is China wants to grow its debt market. Now, in order to do that, you need infrastructure for participants to analyze credit properly. And the infrastructure that I have in mind include hedging tools, includes the data transparency, free press, if you will. But last but not least, it needs a good credit research and credit rating system. On the rating side, a lot of issuers are rated AAA, as you know, and once you go below A- on a national scale, you have no data. That's on the rating side. On the research side, there's not a lot of research on a renminbi bond market. So it's a bit difficult for investor to figure it out.
Varut, last August, the government imposed the 3 red lines. What are these, and how will these 3 requirements impact the Chinese property credits?
Now, if the property sector issuer cannot maintain cash to short-term debt above 1, it cannot raise debt above a certain level, above a certain percentage. But here's the thing, in my judgment, it's not the end of the world for the issuer to have cash to short-term debt below 1. If you believe that the issuer can, refinance the debt using the relationship, number 1. Number 2, if the issuer can basically have cash flow coming in to pay off debt around, along, in the next 12 months, then that would be fine as well. So I would say the 1.0 multiple of cash short-term debt is actually a bit draconian, if you will. Okay, so the impact is this. There's two impacts. The first impact is that the property companies, they will need to raise cash quickly. Okay, so they have to reduce their price to raise cash. Okay, number 2 is that those properties developers, they need to issue equities or reduce debt. So there are 2 ways to do it. So it's not necessarily a bad thing, but it's just a bit draconian, if you ask me.
Thank you so much, Varut.
Thank you, Christine. Appreciate it.
And thank you, everyone, for watching. For more stories like this, please log on to asiatimesfinancial.com for the best Asia news on markets, economies, and more. I'm Christine Zhou reporting for ATF TV.